Welcome to the Explainer. Okay, let's dive into this. Today, we're going on a journey to explore exactly how technology systematically dismantled the traditional gatekeepers of the financial world. We're looking at a complete, ground-up structural shift in an industry that, for a very, very long time, relied heavily on some extremely expensive middlemen. But to understand where we are today with automated investing, we really have to understand where we started. Investing based on a gut feeling is just astrology for men who wear cufflinks. Man, I absolutely love this quote. It brilliantly illustrates the absolute absurdity of the old suit and tie era of Wall Street. For decades, the entire finance industry operated on this incredibly well-marketed illusion of absolute certainty. But if you scratched just beneath the surface, so much of it was literally just guesswork dressed up in a really expensive suit. Section 1. The Suit and Tie Era. If we rewind to the 1980s, you had this archetype of the Gordon Gekko trader. Massive egos, huge shoulder pads, and an industry built almost entirely on storytelling rather than hard data. Let's actually walk through the highly inefficient process of those old money managers. A financial advisor would read through endless filings, listen to hours of earnings calls, analyze trading multiples, and then inexplicably ignore literally all of that data because he had a hunch about a stock. Markets back then were incredibly opaque, and information moved at a snail's pace. So crafting a really compelling story like, oh, the management team looks strong, or I'm telling you the balance sheet is healthy, was essentially how these guys justified their super hefty fees. I mean, sometimes they were right, often they were wrong, but one thing was for sure, they were always charging you for the story. Section 2, enter the math nerds. Let's move to and see how this builds, because by the late 1980s, the entire dynamic shifted drastically. Guys with PhDs from Harvard and Math Olympiad medals basically entered the chat. The old Wall Street, as we know, was all about narratives, opinions, and those famous gut feelings. But these new quants completely reframed the conversation. Instead of asking that traditional question, is this a good company? Quantitative funds started asking a very different question. Given these variables, what is the expected statistical outcome? They realized human behavior repeats itself, and where it repeats, statistical patterns emerge. So they replaced stories with rules and opinions with cold, hard probabilities. It was math over instinct. And, spoiler alert here, it worked out incredibly well. In fact, it worked to the tune of 60% annualized returns before fees. That absolutely staggering number belongs to the Medallion Fund, which is the flagship hedge fund of Renaissance Technologies, founded by mathematician Jim Simons. This is widely considered the most successful investment vehicle in human history. And what's wild? It was entirely algorithm-driven. There was zero fundamental stock picking, no human going on CNBC for a hot take interview, just pure, unadulterated math and machine learning operating quietly behind the scenes. To put that into perspective, imagine taking $10,000 and compounding it at Warren Buffett's historical average of around 19% over 20 years. You'd end up with a very respectable $324,000. Not bad, right? But if you invested that exact same 10 grand at the Medallion Fund's 39% after-fee returns, you'd have over $7 million. No way, right? But it's true. This completely validates the sheer power of algorithms. Systems were dynamically reacting to price movements at superhuman speeds that a human brain just literally could never compete with. Section 3. The Everyday Investor's Pivot. So, while the billionaires were flocking to these highly secretive quant funds, the early 2000s saw everyday retail investors finally starting to wake up to a pretty harsh reality about traditional Wall Street. The data was piling up, and it was overwhelming. Roughly 90% of active equity fund managers underperformed their benchmark over long periods. And we're not just talking about during bad years. We mean consistently. When you factor in the fees they skim off the top to manage your money, the results are actually even worse. Everyday investors finally started looking at their portfolios and asking the most absolutely crucial question: why on earth am I paying extra to a guy in a suit just to underperform the market? And that realization gave massive momentum to index investing. It's a low-cost, passive strategy where instead of paying high fees to try and find the one needle in the haystack, you simply buy the whole haystack. It was the beginning of the end for the traditional stock-picking money manager. But people still needed someone to handle the boring stuff, right? The rebalancing, the tax optimization. Enter the robo-advisor.
Now, we need to clear up a massive misconception here, because when people hear the word algorithms, they tend to lump everything together. But comparing a quantitative hedge fund to a robo-advisor is literally like comparing a Michelin star chef to Chef Boyardee. Quant funds use incredibly complex algorithms to beat the market. Robo-advisors? They don't beat the market at all. They're just automated platforms designed to handle the boring Excel spreadsheet busy work, like basic asset allocation that your human advisor used to charge you 1% a year to do. And let me tell you, everyday investors absolutely loved this value proposition. Robo-advisors went from managing $187 billion in 2017 to nearly $2.8 trillion in 2023. And by 2027, that number is estimated to hit $4.7 trillion. This isn't just a cute niche trend in tech. This is a complete structural shift in a long stagnant industry. The capital is aggressively and permanently flowing away from the human middlemen.
Section 4, the personalization illusion. So the crucial point is, while robo-advisors are a massive step forward in reducing fees, they do have a hidden catch. See, on the surface, these platforms market themselves as hyper-intelligent, bespoke AIs creating personalized investment solutions. But let's walk through what actually happens. Step 1, you sign up and fill out a questionnaire about your age and goals. It feels super intentional. But step 2, instead of an AI building a totally unique plan just for you, you're actually just categorized into a statistical bucket. And step 3, you were slotted right into a model portfolio shared by literally thousands of other people who clicked the exact same multiple choice answers you did. The illusion of a tailor-made strategy is totally shattered, but honestly, that's fine, because hyper-personalization was never their true purpose anyway. Section 5, the end of the middleman. Because at the end of the day, their true purpose comes down to your wallet. The primary goal of a robo-advisor was simply to kill the operational role of the traditional financial advisor. You see, for decades, financial advisors weren't actually paid for outperforming the market. They were paid for access. Markets used to be opaque, data was super expensive, and investing without a guide was like trying to assemble IKEA furniture in the dark without instructions. But then the internet showed up. Boom. Information asymmetry completely disappeared overnight. Market data became free. The financial advisor was no longer guarding the gate. And suddenly, paying someone 1% of your wealth every single year just for access started to look highly questionable. We have seen this exact pattern before, haven't we? Travel agents didn't disappear because we stopped taking vacations. They vanished because booking a flight online stopped requiring a phone call. Stockbrokers didn't disappear because people stopped trading. They vanished because clicking buy on an app was faster than yelling at a guy on a trading floor. And now, financial advisors are being squeezed out by robo-advisors. Whenever access in an industry becomes free, technology inevitably automates the middleman layer. Which brings our entire chronological journey today into focus with this really powerful thought. When technology touches a stagnant industry, it doesn't make small tweaks. It forces fundamental changes. Whether it's math nerd quants replacing big ego hedge fund managers or automated robo-advisors replacing your local financial advisor, the direction is entirely the same. The middlemen have been forced out by code. So as we wrap up this explainer, I want to leave you with a provocative question. Knowing everything you know now about the evolution of finance, the statistical underperformance of humans, and the incredible automation of algorithms, would you trust a robo-advisor with your money? It has completely reframed how we think about wealth, and the landscape is only going to keep shifting. Thanks for joining me as we unravel the numbers behind the disappearing middleman. Keep questioning the system and keep learning.